Today's focus is really strange. All the whales are trapped. BlackRock has started selling coins, and will Ethereum and Bitcoin be dumped through their support levels? A once-in-a-century technological turning point has arrived, and the question is how much longer the market can hold on. It's Tuesday, February 10th, and this is the BTV Chinese channel. Where's the face change? I'm Michael, greeting everyone from Hong Kong. Now, bringing everyone back to discuss the system, the current situation is that the market can't take off on the spot. It's in a phase of just catching its breath. The trend, strength, and structural index of Bitcoin on Binance. It's already very clear that we're seeing structural weakness. Bitcoin has dropped back to around $70,000. Not only has it failed to recover the 50-day moving average, but the gap from the 200-day moving average is starting to widen, which shows that the previous upward momentum is now ebbing away. Looking at the structure, the M50 is around $87,000, while the M200 is still between $102,000. There's a significant gap between these two lines. So it's clear that the market hasn't yet repaired its structure. It seems more like it's searching for a reasonable price range after the previous rise, rather than about to start a new trend immediately. Let's look at the ZIG indicator. It's about -1.6, which is already below the midterm average. This situation suggests that selling pressure is gradually being released, risk appetite is cooling down, and leverage is slowly exiting the market. Historically, this kind of scenario is usually seen during periods of sideways consolidation and bottoming out, when the market is rebuilding its structure, rather than signaling a V-shaped reversal. For rational capital, the current situation is more about waiting for a signal rather than rushing to catch a reversal. At the very least, we need to see the price climb back above the M50 moving average and gradually recover toward the M200. Only then would that be one of the signals of a trend reversal. All right, let's take another look at this round of the pullback. In fact, there's a rather uncomfortable detail. Bitcoin once fell below the cost price of medium-sized whales holding between 100 and 1,000 coins. And what is their cost price? $69,000. So if you look at each address, that's roughly between $7 million and $70 million. In other words, a portion of these medium-sized whales are now collectively underwater. The market is testing them, testing whether their conviction in holding is strong enough. Historically, situations where these medium-sized whales are trapped are actually quite rare. Usually, when this happens, it tends to occur during the mid to late stages of a cycle when pressure is being released. So the last time this happened was in June 2022. Back then, the price kept this group below their cost basis for 7 months. That was a period of continuous deleveraging, gradually restoring confidence, a phase of structural testing. So this current downturn is actually not just ordinary volatility. If the price keeps failing to return above $69,000 for a long time, then it means the market will need to find a new emotional equilibrium and a new overall chip structure. But if the price can recover quickly, at least it shows that this selling pressure has already been absorbed. The risk, or rather the most dangerous phase, has gradually passed. All right, let's look at the same data for Ethereum during this pullback. Ethereum has actually reached a very rare position here. The price at one point even fell below the real cost basis of at least 100,000 Ethereum holders. For these people, each address holds at least $200 million. So what is their average cost? $2,075. In other words, even these long-term whales are now collectively underwater. So the market is testing whether these hardcore funds can withstand the downturn. So historically, this kind of situation is actually quite rare on Ethereum. It usually only appears in the latter half of the cycle, during value reevaluation and deleveraging phases. The last time was in September 2018. When Ethereum stayed below this cost line for 6 months before bottoming out and starting a new cycle. So looking at it now, this seems more like the stage where the risk structure is quietly reversing and the market has already priced in the pessimism. It's already been factored into Ethereum's price in advance. If there's going to be another systemic crash, it would probably require new variables or a black swan event. So the conclusion isn't that Ethereum will bottom out immediately, but rather that for patient capital, Ethereum has already entered a phase that's more suitable for capital looking to gradually build medium to long-term positions by trading time for opportunity rather than rushing to catch a rebound. So at this consensus conference, the biggest impression I got from chatting with everyone is that while we look at things on a weekly chart at most, others are looking at 4-year or even 8-year horizons. After covering the positive data, let's go through the news. Our channel is here to help you keep track of all the news in the Web3 world every day. People always say you can't earn money beyond your level of understanding. So how do you improve your understanding? You need to be aware of what's happening in the macro environment, news, information, and sentiment. What changes are really taking place in Web3 or the new financial paradigm? While we're in Hong Kong, we'll bring you first-hand updates on what's really happening at the Consensus Conference and what the atmosphere is like. Meanwhile, on the mainland, 8 ministries are joining forces to crack down. When it comes to RWA and stablecoins, how should Hong Kong's narrative be framed? These are all things that everyone must and should pay attention to. These are very important news items for improving your understanding. So, what's the headline today? Before the Consensus Conference kicks off tomorrow, let's look at a debate between Cathie Wood and the renowned investor Peter. They had a very interesting discussion about a new paradigm such as AI and robotics. With foundational technologies like new energy and blockchain being increasingly widely applied, how can we all position ourselves for the next round of structural paradigm shifts? So, this conversation between the two of them is very interesting.
You know, the worry historically has been, how many of these things are there going to be? Is this going to be a very fragmented situation? And we're learning who the big winners are going to be, who the big winners are. And I think that's very important. And then the third revolution is that this is a new asset class.
In their conversation, Peter Diamandis and Cathie Wood believe that we are at a technological inflection point that only occurs once every 125 years. 5 major technologies, robotics, energy storage, AI, blockchain, and multi-omic sequencing, are rapidly converging. The ARC model predicts that by 2030, the actual global GDP growth rate could reach 7%, far exceeding the historical average of 3%. AI is undergoing the most dramatic changes, with inference costs dropping by 99% in a year, software costs falling by 91%, intelligence approaching zero marginal cost, and the barriers to production and innovation being significantly lowered.
And it won't be, of course, just Bitcoin. It'll be Ether, importantly, Ether. Solana, maybe Hyperliquid, we shall see. But what's interesting about this period is that the big 3 have been identified. And those are Bitcoin, Ether, and Solana.
The core conclusion is that crypto assets are moving from a phase of decentralized experimentation to an asset class characterized by winner convergence. ARC believes that Bitcoin, Ethereum, and Solana respectively serve as the store of value, smart contract platform, and high-performance execution layer. At the same time, there is a revival of nuclear energy, the emergence of space data centers, the implementation of autonomous driving, and intensifying AI competition between China and the US. ARC remains bullish on Bitcoin in the long term, viewing it as digital insurance against inflation and a hedge against systemic risk.
To sum up what Cathie Wood said, the debate between these two people is essentially about the new paradigm of finance. When all means of production and production relations are changing, if you still use the old logic to judge the 4-year bull and bear halving cycle or the liquidity cycle, it may no longer work. Now, every industry is innovating, especially with AI breaking down industry boundaries and driving costs to the lowest possible level. That's why Cathie Wood emphasizes that if you invest properly, in the future, an annualized return of 35% in the innovation sector might just be the starting point. Of course, this figure is just to help everyone understand that if you're still holding on to that old ticket, you might really miss out on this new wave of financial opportunity. So what's being tested now is whether you're still using old standards and measures and which protractor you're using to gauge the innovations in today's new finance and the new paradigm of the future. All right, besides keeping an eye on major events in our news, we also need to watch the flow of funds. A couple of days ago, I mentioned GameStop. This one, lacking in style, has already completely cleared out all its Bitcoin holdings, right? Today, there's a very negative signal. BlackRock has transferred $247 million worth of Bitcoin and Ethereum in bulk from its ETF vaults to Coinbase's exchange. The intention here is obvious. They want to dump the market, so the entire market is on edge. In my view, BlackRock is the last one that should be leading this wave of massive sell-offs because its demonstration effect is just too significant.
According to on-chain monitoring data, the world's largest asset management firm, BlackRock, has transferred approximately $247 million worth of crypto assets from its spot Bitcoin ETF, IBIT, and Ethereum ETF, ETHA, custody addresses to Coinbase Prime, including 2,268 Bitcoins and 45,324 Ethereum. This operation itself is in line with the standard procedure for ETFs to handle redemptions, but it occurred at a sensitive time following last week's market crash triggered by traditional finance deleveraging. Moreover, monitoring parties have indicated that further transfers may continue, so the market views this as an on-chain signal of potential institutional selling preparations, which has heightened expectations of selling pressure.
So, to a certain extent, BlackRock's selling activity can influence the market's direction, but everyone needs to understand one thing. This is different from the GameStop sell-off. BlackRock actually doesn't participate in market speculation. Like JP Morgan, its main role is risk hedging. There are a few strict conditions under which it sells. The first is that if its investors or authorized participants, APs, request asset redemptions, it must sell Bitcoin or Ethereum. The funds are then returned to investors in the form of US dollars. There's also an SEC regulation. For these ETF institutions, if the Bitcoin or Ethereum they hold is deemed to have insufficient liquidity under extreme circumstances, the institution will be required to forcibly reduce its holdings to control portfolio risk. So, BlackRock selling does not mean they are pessimistic about the future of crypto assets or Ethereum. Many times institutions outperform because they have a comprehensive risk control system or mechanisms for reducing or increasing positions that are strictly by the book without sentimentality. With a single-day trading volume of 700 million US dollars, the giants are all fiercely competing over equity. What kind of explosive potential and appeal is really hidden in the prediction market? A Korean employee accidentally sent out 620,000 bitcoins. Was this due to a system flaw at the exchange or human error, and this time in Hong Kong? Actually, our interactions with industry leaders. I do have my own inclinations. I reached out to LTP, Wintermute, and other major players, those with aggressive tactics, or the more compliant and steady market makers. I interviewed their CEOs one-on-one. Later on, everyone will be able to see a series of interview programs. Why are we looking at this wave of liquidity? Market makers are like ducks that sense the warmth of the river first. If they start to feel a liquidity crunch, then it's highly likely that this round is a bear market. We still have to wait it out for a while. Of course, where is the must-have hotspot right now? In the prediction market, a very well-run company has emerged, Job Trading. What do? They're not about storytelling, nor about generating traffic. They focus on high-frequency trading, leveraging pricing efficiency. They're sensitive to only one thing. Wherever a new price discovery battleground is forming, that's where their attention goes, on the prediction market. This is currently the hottest concept, which also shows that, in the eyes of most investment institutions, the future world will be filled with all kinds of uncertainties, and these uncertainties can be perfectly absorbed by financial assets and priced in advance. By positioning themselves ahead of time, they turn into a new asset class.
According to public data and industry statistics, the prediction market underwent a significant structural leap between 2025 and 2026. In 2025 alone, the total transaction volume in the prediction market nearly reached 50 billion US dollars. By 2026, there were multiple instances where the single-day transaction volume exceeded 700 million US dollars, and liquidity became highly concentrated on the leading platforms.
So I think we're doing 40 billion in annualized volume now. Up. So last year at the same time, right before we got the election approval, I think we were at 300 million in annualized volume. Now we're at 40 billion, and it's growing by about 20% week over week. So top line growth is around 20%, retention is up, activity is strong, everything is moving forward.
Based on recent estimates of 7-day trading volume, the current market share among the top 5 platforms is roughly Takeshi about 28%, Polar Market about 26%, and Opinion about 15% to 20%. Probable is about 15% to 20%, and Limitless is less than 10%. However, the efficiency of unit liquidity is quite high, and this structure is extremely important. The market has now entered an oligopolistic and deeply competitive phase, and this is precisely the kind of environment where market makers can best leverage their advantages.
So now you're talking about RWA, about big changes in US stocks. If you don't cover this, you have to talk about prediction markets. Kelsey focuses on compliance for institutions and big money, connecting them to global retail investors instantly. Listings are fast with a diverse order book. Regarding trading, it remains a neutral observer. Who can become the central pricing event in the financial world? Of course, one common criticism of prediction markets is that they might steer public opinion, or that political topics could be misinterpreted, and that many social trends could be influenced in the wrong direction. If you interpret prediction markets as a gambling platform wrapped in financial or compliance packaging, I think that's not an unreasonable explanation. What do you think? So these negative comments? Once we take it seriously, we've already lost. Just a couple of days ago, there had to be a shocking moment. The coin price dropped straight from 68,000 to 60,000. What exactly happened, right? On a major Korean exchange, over 600,000 Bitcoin were supposed to be labeled with the USDT suffix. But due to human error, they were marked as BTC, so users were issued over 600,000 BTC. Although in the end, 95% was recovered, this incident has already revealed that the industry's regulation, centralized exchanges, always carry one fundamental risk: human error.
Cryptocurrency exchange, Bithumb has admitted to a major operational error after it accidentally distributed more than 600,000 bitcoins to customers during a promotional campaign.
Last Friday, during a marketing campaign by a Korean crypto exchange, an employee accidentally selected Bitcoin instead of the intended Korean won as the reward, resulting in about 620,000 Bitcoins being mistakenly sent to 695 users.
With over $40 billion at current prices being issued instead of the intended small cash awards of about 2,001 per user, the mistake triggered a sharp sell-off on the exchange, briefly disrupting trading.
After users noticed the sudden surge in their account balances, they quickly sold off their holdings, causing the price of Bitcoin on the platform to drop by about 17% within just a few minutes. The exchange then froze the affected accounts within 35 minutes and managed to recover about 99.7% of the mistakenly sent assets. The remaining losses were covered by the platform, but regulators did not consider this a one-time mistake. FSS Director Lee Chan publicly classified the incident as a systemic flaw, stating that users who refuse to return the mistakenly sent assets may face legal consequences.
Of course, such a major incident could be blamed on an employee's slip-up, but it clearly reveals that the exchange's internal risk control mechanisms have shortcomings. Can implementing AI and adding regulatory systems solve this? No, it can't. There is still the possibility of human error, so what's most satisfying about this incident is that the Korean regulatory authorities actually told the exchange that if users sold the Bitcoin, you can't hold them accountable. Because it's not the user's fault, the problem is yours. When will our mainstream exchanges make such a small mistake too, right? But then again, whether you can actually pocket the money is really hard to say. All right, let's move on quickly.
Tesla CEO Elon Musk recently made a statement on the X platform. As long as someone is sued for exposing the truth about the Jeffrey Epstein case, he's willing to pay for their legal fees. And this just happens to coincide with a sensitive moment when the U.S. Department of Justice released over 3 million pages of related documents all at once. As soon as the market cools down, the hype fades away. Google Trends shows the crypto search index has dropped to just 30. Compared to last August's peak score of 100, it has dropped by 70%, on par with the Luna crash. Clearly, market attention has significantly waned. Sam Bankman-Fried recently published a lengthy post from prison on the X platform, systematically defending himself in his case. He claims that FTX did not actually go bankrupt, denies any misappropriation of funds, and further accuses the Biden administration of interfering with the judicial process, stating that he was deliberately prevented from submitting relevant evidence, thereby undermining his right to a defense. This year, at the 60th Super Bowl, only one presence from the crypto world remained among the advertisers. According to Decrypt, Coinbase was the only major cryptocurrency company to place a primary advertisement. Precious metals are clearly heating up. According to Get Market data, spot gold has surged past $5,050 per ounce, rising 1.72% in a single day. Silver has been even more aggressive, jumping 5.65% in one day. It's clear that capital is flowing into safe haven assets.
This time in Hong Kong, we're basically interviewing all the big names attending Consensus, at least at the CEO level. I've noticed the biggest difference is that for retail investors, when you look at our weekly review and see the weekly chart, a lot of people already feel like, wow, that's such a long-term cycle. A lot of retail investors are looking at the 4-hour, 1-hour, or even minute charts. That's the biggest difference between institutions and retail investors. So when many people talk about the crypto market in 2026, most of them aren't misjudging the direction, but rather the timing. As you all know, from a regulatory perspective, it's no longer just a choice between restriction or openness. We've entered an era of what? Of detailed management cycles, how to regulate, how to investigate, how to allow things in stages. So what's the issue here? Especially for retail investors, they often see headlines about favorable policies or regulatory easing and rush to buy in. But what they really overlook is what actually determines the price, the time lag in implementation, and the friction costs involved. Regulation isn't like turning on a faucet where water flows immediately. It's more like gradually opening a valve. If you look at the process, from soliciting public comments on draft regulations to finalizing detailed rules to institutional allocation, it can take several months or even longer before real money actually enters the market. However, the market often prices in these changes ahead of time, so by the time the policy is truly implemented, it's actually when prices start to enter a correction phase. So this year, the biggest risk isn't about how much negative news there is, but rather about treating things that will happen in the future as if they've already happened now. At this stage of the bear market, understanding the rhythm is more important than betting on what regulators might do in the future. So grasping these slow-moving variables, rather than chasing news that might cause immediate price surges, will have a greater impact on your profits and losses in the crypto space. Alright, that's all for today's content. Here are our membership benefits. We hope you'll take a look and see what special perks we offer to our members. We hope to work hard together with everyone so that during this cycle of bull and bear markets, we can gradually become wealthier. See you tomorrow.